Good evening, ladies and gentlemen. Great to have all of you here. We are, of course, coming to you from the sidelines of the Motilal Oswal Wealth Creation Study. It's the 29th edition. Each study, of course, is something to behold. It's a study into which a lot of hard work goes in. Raamdeo ji, of course, spearheads the study, but an entire team is involved. And, of course, it's been our pleasure at CNBC-TV18 to bring this study to you year after year. As I said, it's a 29th study. Raamdeo ji was earlier joking with me that at least about 5 years of his life have gone into the wealth creation study, maybe more. And we'll get to it in just a bit. It's a very specially curated panel that we have with us today because we'll hear not just from investors. We have Raamdeo Agrawal, of course, with us. Amit Goela needs no introduction as well. He's a veteran investor, partner at Rare Enterprises. He's been with Rakeshji's side for 20 years plus. And he's, of course, seen the ins and outs of markets for a long time. But we'll also hear from corporate veterans. Anish Shah is Group CEO, MD at the Mahindra Group, someone under whose watch the Mahindra stock has gone up about 4 times. Anish, great to have you with us here. Thank you very much. And, of course, Mr. Akhil Gupta joins in as well. He's, of course, Vice Chairman at Bharti Enterprises, someone who's, again, been in a sector which is... I think has been a tricky one over the last 2.5 odd decades, but Bharti, of course, under his leadership, has emerged as a big winner. So once again, thank you all for being here. Now, the topic for the discussion, of course, is how to profit from bruised blue chips. And that is essentially what we're going to be talking about. There is, of course, the wealth creation component part of it, which I will get to in just a bit. But I think it's really interesting how to profit from blue chips which have fallen out of favor, bruised blue chips, as Raamdeo ji put it in his study. So, Raamdeo ji, why don't you set the context for us? What do you mean by bruised blue chips? How do you decide that they are really bruised? And how does repair happen? And when do you buy them?
So, I think there are 2 aspects. One is the definition of blue chip itself, and then how do we define the bruised blue chips? So, blue chips are the companies which in our view earns at least 20% return on equity for average return on equity for 10 years, and that does the magic of creating wealth for the companies. So 10 years of average return on equity, there are not many, maybe 25%, 22% of the listed companies in top 250 are blue chips. And then also by size, you need to have size and stability leadership. So top 50 Nifty companies and the companies of 250 at the companies with 20% ROE, we have termed them as blue chips. Because blue chip is practiced all over. Everybody talks about blue chips, but nobody tells the definition of blue chips. So we have defined for the study definition of blue chips. Second is, what is a bruised blue chip? Bruised blue chips are companies in last 5 years, whatever is the high, and now the companies have fallen by more than 50%. Say if company has gone to say 1,000 and it has fallen below 500, 60, 70, 80%. So those companies are bruised. They have not lost the blue chip status, but for some reason, competition or failure products or regulator or whatever, the stocks have fallen by more than 50%. That we call them bruised. So these are the 2 things which we have to keep in mind while talking about bruised blue chips.
Typically one would imagine, Raamdeo ji, that blue chips don't get bruised, right? Once in a while they do. COVID happens or the GFC happens, but otherwise blue chips are blue chips. But as your study shows, they do, and quite regularly.
Yeah, quite regularly, every year. If you see the study period of 5 years, every time out of 250, 78 companies are the blue chips on an average. And of that 40, or literally half, they get bruised. Other half, they don't get bruised, as you say. But 40%, so no blue chip has traveled the journey without getting bruised. Maybe TCS or Infosys might be 2 or 3 companies, but actually almost all the companies, they go through a rough patch, and that is the point of time when they're deeply bruised. I think if you understand the company, you can buy tons of them.
And as your study shows, the hit rate is pretty good. When you buy them at that very bruised state, you tend to make a lot of money.
I have not practiced. Probably Amit can talk more about it, because for me this is just the study.
Right.
But if you practice it, few companies I know for sure which came to my mind. That was one of the Jindal Steel. Since I know that company, DLF at 70-80 rupees, I have gone on record saying that this is a great time to sell your real estate portfolio and buy into DLF. So 2-3 companies I remember, but I have not made too much of money out of bruised blue chips.
Amit, that's a cue for you. Raamdeo says he's not practiced it, but you've been a big practitioner over the last 2 decades plus. So tell us a little bit. I mean, you heard the presentation earlier, you heard Raamdeo explaining it.
One of the core style of dear Rakesh and your mentor and partner and boss, I mean, I think he had the unique style of picking these companies. Because whenever I used to meet him, he used to tell me, this is the Raamdeo, this is the stock I bought, why don't you buy them? Chahe Scores ho, chahe Indian Oil ho. But I never could see the light of why he's saying so. In fact, I used to feel this guy is already drunkard and probably he's telling me something which he wants to pass off. I mean, that used to be my feeling. I never made money out of it. And he was so sincere. He always wanted me to make money. And now I can see that what he wanted. But it's too late. Anyway, Amit.
Yeah, Raamdeo, thank you for having me here. So Prashant, as you said, I've been with Rakesh ji. So Rakesh ji was the practitioner of this kind of investing. I was supporting him, I was helping him doing the work. But the real practitioner was Rakesh ji. And I've seen him consistently over a period of time pick stocks like this which were in trouble or the companies were in trouble, and he's made serious money in them. And the quote, the starting, he never coined them as a bruised blue chip or anything of that kind. He was a value investor. And his starting point was that cannot be a loss of capital. See, he would invest through leverage. And he would service the debt through either dividends or from trading income. So there was no question of a capital loss. So anything which was like a book value, though I don't even remember calculating too many times around when I was around him. But PE was quite critical, and dividend, like sometimes most of these companies were not even giving a dividend because they were in bad shape. So the PE was very critical. The market cap in terms of the opportunity, that was very critical. Those are the couple of things he would look at. And his basic core was there cannot be a capital loss. So he said, my edge is I have time on my side. I'll keep sitting tight. I don't have any benchmark to beat. I don't have to prove anything. And so I will remain invested, but I cannot have a capital loss. That was his basic core of investing in these kind of companies. And he had a very open mind. So it was not, I will only look at one sector. He invested across sectors. We were sector agnostic. Yeah, like so.
You know, let's get this very well put, Amit. Anish, you know, we get the investors' viewpoint all the time, but it's a hall full of investors waiting to hear from you and Akhil. You came into Mahindra & Mahindra, and I dare say, M&M was not bruised, but it was going through a tough patch. And you came in and you turned things around. Talk to us about that point when you came in. What was on your mind? What was the task given to you? And generally, what were the conditions? I mean, what was the experience like?
The start of the first phase of my role, the first year was as Deputy MD and Group CFO, began on 2nd April 2020. And that was a time when we had just hit a low point. The stock had lost about 70% of value. SsangYong was a major burden, and we had close to 5,000 crores of losses from what I called our loss-making entities. And as a result, the results of that year were just about break-even. And it was the start of COVID, and no revenue for the first month of April. So that was the starting point. But the foundation was very strong. And that's one thing I want to highlight in terms of the bruised blue chip story, is that the foundation had been built over many years. And in fact, it was a Motilal Oswal analyst report that in 2018 had highlighted that M&M was the best performing stock in the Nifty since 2002. And that doesn't happen easily. So there were many elements of the company, of the group, that were important and took us forward and helped us weather the storms. Yes, there was some reason for the storms, but the people we had, the talent was of a completely different quality. The ethos of the company, the purpose-driven approach, the focus on entrepreneurship, all of those were elements of the DNA of the company. And which is why even through those storms, we never really were very concerned, because we knew that we were going to get out of that very easily. So I give a lot of credit to our predecessors who really helped set us up for success. And we had to just go forward and implement the few things that we felt were important.